Welcome. In this video, Zbcn Coin 17X bullish income, we will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
In technical analysis, a price breaking a specific resistance level is generally considered a very important and critical development. This is because resistance levels are areas where the price has struggled to rise above in the past, where sellers have concentrated, and where buyers' strength has been limited. Such zones have established themselves in investor psychology as selling points. However, when the price breaks through this level strongly, the psychological effect of that zone largely disappears. At the moment of the breakout, there is a significant shift in market dynamics. A large portion of investors who are waiting to sell have closed their positions, or selling pressure has decreased, while buyers have strengthened and taken control. Let's break this down step by step. The price had been moving toward this resistance level for some time. It may have tested this level several times before but failed to break it. Each time it was tested, selling pressure increased and the price pulled back slightly. But this time the situation played out differently. This time the price surpassed the resistance level with a strong buying wave, high trading volume, and a positive market sentiment. This breakout represents not only a numerical move, but also a psychological threshold. With this breakout, investors start to believe there is no obstacle in front of the price anymore, which in turn increases demand even further. However, there is a far more important detail here: the price returning to the same area after the breakout to make a retest. In technical analysis, a retest refers to the price testing a broken support or resistance level again. This acts as a kind of confirmation mechanism for the market. The broken resistance level turns into a new support area with the retest. In other words, the price first surpasses this zone, then pulls back to it, and if buyers step in again and push the price upward from there, it signals that the breakout was not false and that the trend is likely to continue. In this scenario, that's exactly what happened. The price broke the resistance, then pulled back to test the level, making a retest, and after this test, it resumed its upward movement. From a technical analysis perspective, this produces an extremely strong continuation signal. This is because it proves that buyers are strong not only at the breakout moment, but also during the pullback after the breakout. This increases market participants' confidence, encourages more investors to buy, and accelerates the upward momentum of the price. A successful retest means the price is likely to continue on its path. By successful retest, we mean that even if the price pulls back, it does not drop below the broken level, holds at this area, and attracts new buying that pushes it upward again. This sends the message in market psychology that sellers are no longer strong enough below this level. As a result, this level permanently turns into a support line. Additionally, the price continuing upward after the retest is not only a signal for a short-term move, but also an indication that the medium and long-term trend has strengthened. This is because it shows that the market has a strong demand dynamic supporting the upward movement. Especially if the price begins making new highs after the retest, it confirms that the trend is intact and buyers remain dominant in the market. In such breakout and retest scenarios, trading volume also plays a significant role. If the volume is high during the breakout, it suggests the breakout is strong and credible. During the retest, if the volume is relatively low and the price pulls back with this low volume, it shows that sellers are weak. Then, when the price resumes its upward move and volume rises again, it indicates buyers are entering the market strongly and the trend is likely to continue. From a psychological perspective, a price breaking resistance and then making a retest creates a critical shift in investors' decision-making processes. Investors who previously said it will rise up to here but won't go further change their minds after the breakout and retest. This situation brings many new investors into the market who had been taking a wait-and-see stance. Additionally, investors who previously sold at this resistance level may re-enter positions once the price starts rising again. This creates extra demand and pushes the price higher. It's also worth noting that the timing and depth of the retest can vary depending on market conditions. Sometimes the retest comes immediately after the breakout, while other times it occurs a few days or weeks later. Similarly, the depth of the pullback can differ. However, the important factor is whether the price can hold above the broken level. This shows the strength of the trend and the durability of the breakout. In summary, a price breaking resistance, then returning to that level for a successful retest and continuing upward afterward is a very strong bullish signal in technical analysis. It proves both the strength of buyers and the positive shift in market sentiment. In such a scenario, it's important for investors to manage their positions carefully, both to maximize potential gains and to stay prepared for any sudden reversal risks. But we cannot base an analysis solely on support. Let's also take a look at other metrics. Stay tuned.
The MACD indicator is one of the most popular tools in technical analysis, used to understand price momentum, trend direction, and potential reversal points. This indicator measures the relationship between two different moving averages and presents this relationship visually through both lines and a histogram. Traders interpret the direction of the MACD lines, their relative position, and crossover points to forecast potential future price movements. What is particularly important here is when the MACD lines begin to move upward, as this is often considered a strong signal that the price may be preparing for a rally. The MACD indicator consists of two main lines, the MACD line and the signal line. The MACD line is the difference between a short-term exponential moving average, or EMA, and a long-term EMA. The signal line is typically the 9-period EMA of the MACD line. When analyzed together, these two lines provide important insights into the direction of market momentum. If the MACD line begins to slope upward, this usually indicates that short-term momentum is strengthening and that the price is under upward pressure. The upward movement of the lines also represents a significant shift in market psychology. Momentum that was previously flat or downward is now signaling that buyers are taking control. This situation, especially when the price is near a previously established resistance level, increases the likelihood of a breakout. The upward movement of the MACD lines reflects growing buying appetite and positive market expectations. An upward movement in the MACD lines is not, by itself, an immediate buy now signal. However, it often increases the probability of the trend continuing upward. If the MACD line crosses above the signal line from below, this is called a bullish crossover and generates a strong bullish signal. Such a crossover can often precede fast and sharp price movements. The reason is that this crossover produces a positive signal, both in terms of technical indicators and investor psychology. Another important component is the MACD histogram. The histogram represents the difference between the MACD line and the signal line. When the histogram shrinks and approaches zero, it indicates the two lines are converging. When it grows, it shows the gap between them is widening. If the histogram stops shrinking below zero and begins to grow again, this signals an upward momentum shift. When the lines move upward and the histogram also enters the positive zone, the likelihood of a price rally increases. A price rally in technical analysis is often associated with strong buying waves. Such moves occur when the majority of market participants begin trading in the same direction. The upward movement of the MACD lines is one of the early signals of this collective buying behavior. This is why many experienced traders monitor upward turns in the MACD before the price fully starts rising. The rising of the lines also means an increase in trend strength. For example, if the price has been moving sideways and the MACD lines start turning upward from below, this may signal the beginning of a new trend. If the price is already in an uptrend and the MACD lines accelerate upward again, this increases the probability of the existing trend continuing. From an investor psychology standpoint, this is also critical. The upward turn of the MACD lines instills confidence, especially among traders who closely follow technical indicators. This confidence can lead to increased buying pressure and cause prices to climb quickly. Additionally, algorithmic trading bots and automated systems that detect this signal may begin opening long positions, further accelerating the rally. Consider an example scenario. The price has been moving sideways for some time, and the MACD lines are coming out of a downward momentum phase, starting to curve upward. Within a few days, the MACD line crosses above the signal line from below, and the histogram moves into the positive territory. At this point, many traders begin to believe the price could be about to surge. Shortly afterward, the price breaks an important resistance level with high volume and begins a sharp upward move. This is a typical situation where the upward movement of the MACD lines serves as a pre-rally signal. However, it is important to note that not every upward turn in the MACD produces the same result. In some cases, even if the signal points to upward movement, broader market conditions, macroeconomic developments, or news events can disrupt the move. For this reason, MACD signals should always be evaluated alongside support and resistance levels, volume analysis, and other indicators. For example, if the price is bouncing off a strong support level and the MACD lines are also moving upward, The combination of these two factors produces a much stronger buy signal. The upward movement of the lines is also important in terms of timing. Traders who spot this signal early can enter positions before the price makes big jumps, increasing potential profit. Latecomers, on the other hand, are forced to enter after the price has already moved significantly, which reduces the risk-reward ratio. In summary, the upward movement of the lines in the MACD indicator is a strong technical signal that the market is gaining upward momentum, buyers are strengthening, and the price is preparing for a rally. When evaluated together with other technical analysis elements, this signal provides traders with a valuable advantage. When interpreted correctly, this movement of the lines can be used to capture both short-term trading opportunities and medium to long-term trends.
The ascending channel formation in technical analysis indicates that the price is moving within a clearly defined band in a specific trend direction, with both its lower and upper boundaries well established. In this formation, there are two parallel lines. The lower line acts as support, while the upper line serves as resistance. Within this channel, the price moves in a wave-like manner, bouncing upward from the lower line and approaching the upper line. As the name suggests, the ascending channel has an upward slope, which signals that the market is generally in a positive trend. The fact that the price is currently within this ascending channel is an important sign that the trend is still continuing in a healthy way. The movement continuing upward without touching or breaking below the lower band shows that buyers remain strong in the market. In ascending channels, when the price approaches the upper band, it often points to potential acceleration in the trend. This is because the upper band is typically a region where profit-taking levels cluster and significant buying pressure builds in the market before reaching this level. The critical scenario here is when the price reaches the upper band. If the price reaches the upper band and breaks through it with strong volume, very sharp increases can often occur. However, in some cases, touching the upper band can act as strong resistance and cause the price to pull back. Therefore, the upper band of the channel should be evaluated as both a target and a risk area. As you mentioned, if this ascending channel's upper band is reached, the price is expected to increase by approximately 17 times, 17x. This ratio represents a very high potential gain from the current price level. Such a rise is possible not only through the technical formation, but also through a positive alignment of market psychology, investor expectations, and fundamental developments. A 17x potential increase is a serious opportunity for investors. Such a move typically results from long-term trends, strong fundamental news, or a major bull wave across the market. Reaching the upper band of the ascending channel shows not only that the price can technically move upward, but also that the vast majority of market participants are trading in the same direction. In such situations, liquidity increases, trading volumes surge, and the price advances rapidly toward the target. At this point, it is also important to mention the psychological aspect of the ascending channel. Each touch of the lower band is seen by investors as a buying opportunity, while approaching the upper band is considered a profit-taking zone. However, in some cases, especially when the market is in a very strong trend, the upper band stops being an unbreakable point and becomes more like a springboard. If buying pressure emerges instead of selling pressure when the price reaches the upper band, this can result in a breakout to the upside. Such a breakout can often lead to gains well beyond the formation target, potentially even exceeding the 17x projection. Every touch and reversal the price makes within this channel affects the emotional responses of investors. Those who buy at the lower band may want to realize their profits when the price nears the upper band. However, the momentum of the rise and the generally positive market environment often make these sales short-lived. Volume analysis plays a critical role here. If volume increases as the price moves toward the upper band, it shows the determination of buyers, making the 17x target even more realistic. Furthermore, ascending channel formations usually indicate that a trend is progressing healthily and that the price can make new highs in an orderly way. Unlike irregular and sudden spikes, movements within channels are more balanced and sustainable. This increases investor confidence. If the price continues to stay within the channel and gradually approaches the upper band, it proves that there is strong buying pressure in the market. The technical target of an ascending channel is generally a breakout potential equal to the channel's width. However, The 17X target you mentioned suggests not only a technical breakout, but also large-scale investor interest, a strong market trend, and likely fundamental developments at play. Such moves have been seen many times in the past, especially in the cryptocurrency market. The price consolidates within a certain formation for a long time. Most investors lose interest and close their positions, and then a strong breakout sends the price multiple times higher in a short period of time. Another important point in this scenario is the stop-loss strategy. Although ascending channels are indicators of a positive trend, if the price falls below the lower band, the trend can be broken. Therefore, investors should set stop levels to limit their losses if the price drops below the channel. This way, while focusing on large targets like 17X, risk management is not neglected. In conclusion, the possibility of a 17X potential increase if the price remains within the ascending channel and reaches the upper band signals a strong opportunity both technically and psychologically. The regular movement between the lower and upper bands of the channel shows that the trend is progressing healthily. Setting the upper band as a target gives investors a clear roadmap. However, for this target to be reached, both technical signals and market conditions must be favorable. If these conditions are met, the opportunity presented by the ascending channel could result in a rise of historic proportions for the market.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.